Kenneth Andrade, Chief Investment Officer with IDFC Mutual Fund, also joins us live. Kenneth, good morning. Thank you for joining us. Kenneth, in the month of September, Nifty is up 7.5%. We are up more than 10% from the recent low. And in dollar terms, the gains are breathtaking. It's double digits. What's going on? Do you think we have some more headroom to go, or fundamentally speaking, we've topped out?
I think we're in this range for quite some time now, and I don't see anything happening over the course of this calendar year. I think a lot of events are ahead of us, both international and domestic. But I think the key moot point of the argument out here is corporate profitability is not going to show a dramatic improvement over the next year or two. And if that's going to be the case, I mean, it's back to a fairly range-bound market for some time ahead. So you'll be in a trading band. I think it's about creating portfolios at this point in time and not really looking at what we went through between the early part of last decade.
So Kenneth, what's the right investment approach right now? Are you deploying fresh cash into any of the equity names, or are you just staying put with what's already in there?
Okay, there are two elements to the market. One is on the fixed income side, and the second is the equity side. The fixed income side is an opportunity where you are getting double-digit returns in corporate bonds out there. So that's fairly attractive as far as the Indian investor is concerned. The other part is the equity part of the entire market, where you effectively buy ownership in businesses, and this is probably not the most comforting time to own a business in India. All said and done, valuations are in your favor, but they've been in your favor for an extremely long period of time. You will make money from here. The timeline is not definite. You need a lot more happening on the macro environment, which effectively refuses to turn around. And if you're going to be in that zone between the toss-up between fixed income or double-digit interest rates and equity, I think both options are very attractive at this point in time. Equities might be back-ended returns, while fixed income is something that you see. What you see is what you get.
Kenneth, now that we've got a sense and pulse of what your broader market call is, let's be slightly sector specific here and let's talk about your portfolio strategy. FMCG is a constant part of your portfolio that accounts for nearly 19% weightage, but you're extremely underweight on financials, and with the exception of HDFC Bank, you don't own a single bank. Step into the last quarter, and we did delve into a couple of cyclicals out there, more specifically public sector banks. But as the incremental environment unfolds itself, it's going to be a challenge for the financials. Financials have historically always been late cycle plays in an environment, so they tend to do well when the economy is doing extremely well. And they're probably the last. They're the last part of the market that actually does extremely. A last part of industry that does extremely well because of a good environment. So I think that's where the call has been. So what we tried to anticipate was a bottoming of the entire economy, which doesn't seem to be the case as it is. A lot of policy framework has to fall into place, and a lot of restructuring as far as the debt of corporate debt has to take place. And it's going to be some time before we hear reasonably good news from that part of the entire environment. So going back to how we orient our portfolios, what we try to do is we try to buy companies which have a reasonably sound balance sheet and do not take too much of solvency risk. Now, when you try to do that in an environment like this, the next question is, what price are you willing to pay for it all? So that's the trade-off that you have. So we're buying reasonably solvent companies who've got extremely robust balance sheets at the end, and there's a price to pay for all of it. So that's how we're putting it together. we had historically liked the consumer part of the economy. We tried to pick into an economy which was we anticipated would bottom out sometime in year 2013-14. But that trade has unwound itself. So the portfolio has gone back to where our thought process has gone back to owning companies we think will survive this entire cycle.
Kenneth, but a follow-up question on consumption is that when Indian economy is contracting, consumption will also contract. Indian consumers are not bulletproof. Urban consumption has seen a significant amount of slowdown. The stocks which you own are Bata, Page Industries, Asian Paints, United Spirits. These stocks or these companies are completely exposed to consumer demand. What makes you bullish on them?
Okay. One is these are all single product companies that are there. Okay. So they're single product companies. They're the largest in their industry in an environment which is actually not growing or consolidating itself. Each of these companies are gaining market share, and that's the ongoing process in the entire environment. So we're not really sitting with a mindset that India is going to be a growth economy for at least in the near term. In the longer term, yes, we'll have to recalibrate it when the environment actually settles down. So in putting a portfolio together, we effectively looking at companies that are consolidating their space in the entire environment. There are no diversified consumer businesses that we own, or there are no significant diversified consumer businesses that we own. And each of these companies that you've highlighted or in the portfolios, they continue to gain traction in their own space that they are in. Okay. When it comes to arguing on a slowdown in the Indian economy and consumer companies will take a hit on in the environment, I think we come to a phase in time in the environment where there is always going to be some kind of pent-up demand that would be there, and as long as the sentiment can be maintained, or the consumer sentiment can be maintained, and per capita incomes don't take a nosedive, I think this part of the market will come back in a year, sometime in the next year, 2 years, or 3 years. As we stand today, none of them have seen a significant amount of downtrading in their respective industries. None of them have seen negative growth that is there, and you still have incremental pricing growth, which is not as strong as it used to be, but there's still incremental pricing growth on the ground. But one thing which is notable amongst all of them seem to be gaining larger traction in terms of growing market shares in the business, whether it's from the existing players, or whether it's from the unorganized part of the market. So I think that's the strategy of trying to put a portfolio together as far as those names are concerned.
Kenneth, you talked about the upside for the market being capped. Do you think it's going to stay put at 6,100, or do you think we could push the bar a little higher from that?
Okay, I just take the focus off the index really, while that's the largest and the most tradable instrument in the market, including the Nifty companies. I think the underlying part of the entire valuations are extremely robust. Okay, now we're not talking conventional price to earnings and price to book ratios, which with some companies might be very expensive because profits don't exist. But purely on a replacement cost basis, it seems to be fairly attractive. Okay, so while the index companies might remain where they are, and the indices might be at between 5,500 and 6,100 for some part of time, I think if you step down into the tier 2 and the tier 3 companies, a significant amount of markets, a significant amount of competitive intensity is dying from the business because balance sheets do not support it, and the financial institutions do not support these businesses. Second is, a lot of these companies have been, a lot of the space has been vacated by institutional investors and retail investors, which is why they tend to trade reasonably cheap in the environment. Now, I'm not saying it's going to change tomorrow, but I'm saying there is a reasonable amount of value that you offer out here. So if you see the deviation in the indices, I think the last 3 years has been the large caps or the index which has held up, while the mid cap indices and the small cap indexes have been completely thrashed. Most of the opportunity would emerge from around that number. Amongst the large caps, yes, there are opportunities that will emerge on a case specific basis, which might lead the market. But as we talk today, between the large consumer companies or the large IT companies or the large oil and gas companies, I'm not too sure if there is a leader in that context that could drive market momentum on the upside. So the last time market hit 6100 and above, I think very clearly there were a couple of consumer names and pharma names that took it there. I don't think I can say it with the same conviction that these companies can continue to do it into the next year or 2 years. So you'll have to wait for leadership to emerge on the big caps. On the small caps, valuations are there. We just have to wait for a little bit of fund flows and some good news as far as the macro or stability as far as the macro environment is concerned. And then I think we should be back to our winning ways.
So what explains the move in some of the energy names? BHEL, for instance, do you think this was just a technical one-off, or do you think this could be start of a meaningful upside in the entire sector?
I don't think India will ever be in a capex mode for some time. Okay, so irrespective of which company that we talk about, we're very far away from being into a capex mode, and the reason is quite clear. One, you don't have the policy framework. Two, you've got a significant amount of companies with work in progress which has not actually gone on stream. And three, the financial system just doesn't have capacity to fund you anymore. So where are you going to get the money to fund it? And if that's going to be the case, we can't really see capital equipment or capital goods as an entire environment actually bounce back like yesterday. I don't think the environment just doesn't support it. And it doesn't support it for this year, it doesn't support it for some time now.
Fair point. How come you've given the popular sectors like exporters a big skip? You manage a mid-cap fund, but you don't own any of the key mid-cap IT names. If I look at the declared portfolio, nothing from the mid-cap pharma space either.
One of the advantages that India has and probably can take advantage of is effectively exports, because the rupee is depreciated. And the fact is that we get reasonably competitive as the environment is concerned. While that holds true as far as plugging it on worksheets is concerned, I'm not too sure that a depreciated rupee can create a very large business out of India, because a weak currency can't be a only USP to manage to grow your business. While it is an advantage, it can't be your single and only USP, because inflation also is reasonably high as far as India is concerned, and sooner than later costs will catch up. I think that's a broader context on why exporters may not form a very large part of our portfolio now and even in the coming few years. But what is very important is there are two ways to handle what we are seeing right now, which is the current account deficit. One is export more, and the second is create a pipeline for import substitution. I think that is the bigger opportunity that is there. And if capex has to come back onto the ground, it effectively has to create a very large capacity on the ground purely for import substitution. And India is a very large market. I mean, India is about 1.5% of global GDP, while we are 17% of the world population. Okay, so you might want to ignore 1.5% of the GDP as far as your portfolios are concerned, or global portfolios are concerned, but you can't wish away 17% of your population. And I think that's where the next manufacturing wave can come. And if we can calibrate it right as a country, that shouldn't be too far away.